Good morning, everybody, and welcome to this our BDO budget webinar, where we're going to reflect and give some insights on the announcements of yesterday. I've just we'll get underway. So the participants have been rising, now sort of plateauing. So we will get underway without further ado. A few housekeeping points before we get underway. So this session is going to be recorded, and we will send the video and the slides to all the participants after the webinar. There is the question and a Q&A functionality. So at the bottoms of your screen, you'll see the Q&A box. If you put your Q&As in there, we'll endeavour to go through those and deal with those towards the end of the session. If you can all take a look around and find your nearest fire exit, that would be good. Not expecting any fire alarms, but just so you know. Introducing the lineup for today. So we're delighted to have Nina Skero from the Centre of Economics and Business Research, who's going to introduce the session with a bit of a reflection on the current economic state of play in the backdrop to the announcements of yesterday. We'll then hand over to Liam, who will take us through business tax changes, who will then Caroline on employment taxes, Martyne on VAT matters, and myself on personal tax matters. And then I say we'll have some time for Q&A at the end. We'll endeavour to get through those any that we sort of can't or a bit niche, we'll endeavour to come back to you offline afterwards. So without further ado, I will hand over to Nina for the economic outlook.
Thank you very much for the introduction, Ben. I am going to dive straight in since there is quite a lot to cover in just 10 to 15 minutes. So beginning with a little bit of the sort of economic state of play that I think is quite important to keep in mind, because this is the economic outlook and current conditions that the Chancellor would have been keeping in mind as he delivered the spring budget yesterday. So if we first take a look at economic growth, so we know that at the end of 2023, the economy was in a recession. And for the year as a whole, we saw quite a low rate of growth at just 0.1%. Now, we do think that at the beginning of 2024, we're actually already out of this recession. So we think it was a quite short, quite shallow recession, but it's still a relatively soft economic outlook. So in terms of what we're expecting in 2024, it seems like quite a big jump from 0.1% last year to 1.3% growth, projected growth this year. But that's actually still a quite moderate figure. It's below what we saw in the years leading up to the COVID pandemic, so it's below trend. It's also to keep in mind what GDP per capita is doing, given that that's probably a better indicator in terms of how people feel and living standards. And GDP per capita actually declined in 2023 and isn't expected to reach its pre-COVID level until 2025. So I think in terms of, at a very high level, in terms of where we are economically at the turn of the year, if I was to sort of to summarize in musical terms, I think that sort of a good representative song for 2023 would have been Dream's Things Can Only Get Better. And I think in 2024, we're sort of in Taylor Swift Shake It Off territory. Things are getting a little bit better, but not great. And I think, next slide, please. If we look at not just CBR's forecasts, but also what others are expecting, and a lot of public sector and actually some private sector forecasts are even less optimistic than CBR. And that's quite important to keep in mind, especially the forecasts at the OBR and at the Bank of England, because OBR's forecasts dictate how much room for maneuver the Chancellor has in any, whether it's this Chancellor or a new one, how much room they have in any future fiscal event. And what the Bank of England is forecasting is quite important. given that it'll feed into their view of monetary policy. So the OBR did revise up its forecasts in their publication yesterday, but they're actually expecting a more modest rate of economic growth of 0.8% for this year. And the reason that CBR is more optimistic than some other ones is our view on the consumer economy, and consumers really seem to be actually quite willing to spend still, despite the economic slowdown, despite higher interest rates. And I will actually come back to that in a moment. So moving on now to inflation, which has been one of the big economic stories in recent years. So we've seen inflation come down quite significantly, and there is an almost guaranteed further downtick coming in the spring off the back of the changes in the off-gen price cap. So that's not really a question anymore. Inflation has come down and it will come down further in the coming months. What is a bigger question is what inflation is going to do in the medium term. And we think inflation is going to sort of not really tick up this significantly anymore, barring any unforeseen external shocks. But we do think it's actually going to take quite a while to get inflation sustainably below target. And that's why if you look at that forecast line in the blue there, it's staying above the 2% target going into the mid and late 2020s. And the biggest reason for this is what's happening in the labor market, which I'll come on to in a second. But in terms of what this inflationary path implies for monetary policy, sorry if I can have another click, please. So the bank rate is at 5.25% at the moment, and we are expecting a first cut to that to 5% in June of this year. And then a series of gradual but sustained cuts, bringing the rate down to 4.25% by the end of this year and down to 3.25% next year. And those are quite significant cuts. But for context, the rate of the bank rate stood at 0.75% just before the pandemic in February 2020. And in the depths of the pandemic throughout 2021, it stood at 0.1%. So it can be easy to trick yourself into thinking that we're sort of entering a period of economic loosening, which we are, but compared to what we've seen in recent years, these are still relatively high interest rates. And one of the elements that we think is going to make it difficult for the bank rate to cut interest rates any faster is the labor market. So if we go to the next slide, please. So rather than showing sort of just one official statistic looking at the labor market, something like the unemployment rate, this is actually a comprehensive measure of labor market dynamics. It's something we compile, and it's called the Jobs Confidence Index. And it does take into account things like the unemployment rate, but also things like vacancies, earnings, and also worker expectations in terms of their job prospects. And I mean, what this is telling us is that it's a very, very hot labor market. Vacancies have a little bit come off the boil, but in general, this index in the long term varies normally between -30 and +30. The higher the number, the stronger the labor market. And at the moment, it's sort of around the 45 territory. So in essence, unemployment is very low. Vacancies are still quite strong. So it's a very tight labor market. And what's that creating is, if we go to the next slide, please, is a lot of sustained wage pressures. So the dark line there at the top shows nominal wage growth, and the bright green line is real wage growth adjusted for inflation. So in a lot of 22, 23, real wages were actually in decline, given how high inflation was. But now inflation has moderated, wage growth is still quite high. So although we are forecasting that to start ticking downwards, if you take sort of a view over the entire time span there, we are expecting wages to continue rising at rates significantly above what we have seen in the pre-COVID years. And the government has talked about including in the budget yesterday, what actions they are taking in terms of boosting productivity, so that there can be economic growth without these continued pressures on hiring. But a lot of government's actions are pretty marginal and also really won't make any difference in the immediate future. So I think this demand on labor, which resulted out of the significant shock that came from COVID, both in terms of people leaving the UK and not necessarily coming back in the same numbers, the fact that I would say that UK has become relatively less attractive to foreign workers, not just in terms of immigration policies, but just I think there's actually less people with a weakening of the pound, with slower economic growth. I think there's less people coming here for the vacancies that we're seeing with those specific skill sets. So I think that combination is going to continue to create a lot of labor shortages and continue to drive up wages, which definitely creates a headache for the Bank of England, which I think would be otherwise keen to cut rates more quickly to support economic growth. And looking next at what confidence is doing at the moment, given that this feeds into everything I've been talking about so far, including the strength of the consumer economy, which of course feeds very significantly into GDP. So looking there at the CBR YouGov measure of consumer confidence, which is actually quite robust, despite the recessionary headlines. I think the reason that confidence has remained pretty strong is that there hasn't been this sort of correlation that you might expect between the labor market and wider economic weakness. So if people can't feel on their own skin, in most cases at least, that there is an economic slowdown, it doesn't impact their behaviors and their outlook as much. And something similar, but to a lesser extent, has been true for business confidence. If we can get another click, please, which we measure here on the BDO Optimism Index, which is a long-running index that CBR compiles in partnership with BDO. And the index has actually downticked slightly, but still, if you see sort of the lows that it has been over the last year and certainly during the pandemic, business confidence is actually holding up fairly well as well. And it is for these reasons that we are actually more optimistic on the economic outlook for this year and next than a lot of the public sector forecasters. And for the end, if I turn to a few specific points relating to yesterday's budget, so I am not going to cover these in any sort of detail, because we're going to have, of course, the BDO experts covering the various announcements in a moment's time. I would say that our overall economic assessment of the budget is that it's not going to make a material difference in terms of our forecasts. And we are still looking at a very high tax burden, and the announcements made around NICs and the other areas, on duties, on the British ISA, in terms of how much fiscal policy is supporting growth. None of this comes close to reversing the effect of freezing income tax threshold. So I would say that on a very macro level, we think that the budget hasn't moved the needle too much in terms of the economic outlook. But in terms of the specific policies, we'll be hearing about those in a second. Now, just again, sticking with the very sort of high-level economic outlook, if we look at fiscal headroom, and you will see that it's quite low compared to historic levels. But I would just like to make 2 points on fiscal headroom. One is that it seems to me there has been a lot of increased media coverage across a lot of general level of interest in fiscal headroom. And given what fiscal rules are at the moment, fiscal headroom really does not mean much. So I am sometimes surprised at how much attention it gets. and it probably gets unwarranted levels of attention in terms of how much importance it has in terms of setting the country's fiscal policies. So based on current fiscal rules, which in themselves are close to meaningless because they're sort of always looking at a forecast 5 years out. At the moment, when we talk about fiscal headroom, we're talking about the difference in the forecast for national debt between March 2028 and March 2029. So that is quite far out. Forecasts change all the time for a whole host of reasons. So I would say, do take not only this chart, but sort of any discussion you hear about the importance of fiscal headroom with a grain of salt. And then secondly, taking the fiscal headroom figures at face value, because these are the fiscal rules, this is the fiscal reality that we're working within. If I was sort of step a little bit away from the economics and sort of, look at these figures through a lens of the fact that there is an election coming up at some point later in the year, you might see how close to using up all of that headroom Hunt has come, and say that this is a chancellor perhaps operating under the assumption that there is going to be a change in government, and that he perhaps in some ways, if you wanted to be cynical, almost wants to leave the next government in a very tricky position, given that to make these numbers work, given how wafer thin that margin is of fiscal headroom. And even to get to that low margin, you need to bake in some extremely significant spending cuts in unprotected areas of expenditure, cuts so significant that they're almost certainly unrealistic. So the picture here does have a little bit of an air of a chancellor that is willing to make some assumptions that he probably knows won't prove realistic. So just a couple of key takeaways very, very quickly. In summary, I would say that the economy is probably out of the recession at the moment, and that 2024 is going to be a better but not great year. One of the reasons for that is that inflation has moderated, but wage pressures are going to keep upward pressure on inflation in the medium term. So which correspondingly is going to keep pressure on the Bank of England to not cut rates too much or too fast. And in terms of the spring budget, we're going to hear a lot more of it just now, but we think it hasn't really moved the needle too much in terms of the economic outlook, and it does leave the next government, whoever that government is formed on, in quite a tricky position right at the start. And thank you very much for that. I believe, hand it over to Ben and our other video speakers.
Thank you, Nina. Thank you very much for that, and that really helpful backdrop against what we heard yesterday. So Nina's going to stay with us throughout this. So I'm conscious that we've had quite a lot of joiners since we got underway at 10 o'clock. So just a reminder that we're going to have Q&A towards the end of the session. Please do post your questions in the Q&A box at the bottom that you see there. So the Q&A bottom, not the chat function, which won't be any use. And we'll endeavour to get through what we can at the end, and we'll pick up afterwards. This session is being recorded. We will forward the recording and the slides afterwards. So without further ado, let me hand over to Liam.
Good morning. I'm going to cover business taxes and stamp duty land tax, and it's probably not too much of a spoiler alert when I kind of say that the stamp duty land tax is probably the more interesting of those two. Next slide, please. There was very little in the budget yesterday on business taxes per se. It's probably worth just sort of highlighting that there was no news on tax rate, and actually sort of that combined with the sort of Labour manifesto commitment to keep the 25% tax rate through the next Parliament, I think gives quite a lot of certainty as to at least the headline tax rate. One announcement that there was, with the ongoing war in Ukraine and the impact that's having on energy prices, the energy profits levy was extended 1 year to March 2029. But interestingly, the electricity generator levy, there was no announcement on that. So the working assumption is that will end as per originally announced at March 2028. Next slide, please. There were then a number of what I've described sort of smaller announcements, which I'll just talk through now. Firstly, capital allowances. Many of you will remember in 2023, the fully expensing regime was made permanent. And that at that point in time didn't apply to lessors, and there was a consultation that was entered into to consider whether that would be appropriate. And it was announced yesterday that lessors are to be included within that regime, but only when the fiscal conditions allow. So there's very much an affordability criteria over the top of that. And we don't have any details as to what those rules will actually look like. There was a comment that details will be published shortly. Next slide, please. An area where there was a suite of announcements was around the creative sector, and there was a number of new reliefs announced in this area to aid sort of film studios in England, independent films. There's a kind of an enhancement of some of the existing reliefs around audiovisual expenditure, and sort of a welcome sort of making the reliefs permanent around theatres, orchestras, museums and galleries. So some very welcome changes there. Next slide, please. Onto investment zones. It was announced that investment zones, the period that they will last for, would be extended from 5 to 10 years in Scotland and Wales. And beyond that, there were announcements that there would be further announcements in the near future. So not much more detail announced yesterday. Next slide, please. And finally, COVID recovery loans. It was announced that they will be extended to June 2026, and they'll also be rebranded as growth guarantee schemes. So, another sign that we're finally putting COVID behind us. If I could go to the next slide. One point that wasn't one area that wasn't sort of addressed in the budget yesterday, but is quite a significant change that's around the corner, is the merger of the two R&D schemes, which is effective for accounting periods starting after 1 April 2024. And these rules have probably been addressed in a number of other sort of seminars and talks, so I'm not going to go into them in a great deal of detail, but just to highlight the bottom bullet point there, which has been announced. It wasn't announced as part of the budget, but it's been announced very recently. There has been uncertainty as to how subcontractor costs will be dealt under the new merge regime. Historically, SMEs have been able to claim subcontractor costs. Large businesses under the RDEC regime haven't. The good news is it is likely that subcontractor costs can be claimed. The less good news is there will be a test to work out whether it is the contractor or the subcontractor who will actually be entitled to that claim, and there will be some quite complex tests around that. So if that affects you, it's probably an area to take some bespoke advice specific to you. Next slide, please. This slide summarises the rates under the merge scheme and how they differ from what's gone on in the past. I won't talk through those. They're the same numbers as we presented last year, and they've been around for some time, but they'll be in the pack of information that comes out at the end if you want to refer to them. Next slide, please. Moving on to stamp duty land tax, and this was an area where we were expecting more changes, and we weren't disappointed. Next slide, please. A couple of years ago now, I think it probably is 2 years ago, there was a consultation into multiple dwellings relief and mixed use acquisitions. And this has also been an area where HMRC have been very, very active with their inquiries into tax returns. And in fact, I think it's probably the area where there's been the single most number of cases heard in the special commissioners in the courts, where it's an area that's been litigated. And you might think, well, why has there been so much activity in that area? And I think largely that's been driven off the sort of very wide range of tax rates we've got for residential sort of property. And that ranges from 0 to 15%. And on top of that, there can be some surcharges. And that compares with the commercial stamp duty land tax rate, which caps out at 5%. When you combine that with the ability to claim multiple dwellings relief, which effectively means that if you're acquiring sort of more than one dwelling, you can divide the amount of consideration you're paying to access a lower stamp duty land tax rate, or mixed use acquisitions that means that if you're buying residential and commercial property together, you potentially access the 5% rate rather than, say, the 15% rate. These reliefs are very attractive. And I think it's fair to say that they've been abused. There are a number of sort of taxpayers and maybe some advisors that have been prompting the reliefs to be used in areas where they shouldn't. And the classic examples of these are the person that buys a £2 million mansion and tries to argue that it's made up of a number of homes, potentially a granny annex, or potentially tries to argue that the kind of the field that's next to it that they own part of is a commercial field used for grazing, and try to access, say, the 5% rate rather than the 15%. And it's claims like that have been clogging up the revenue and clogging up the courts. What's been decided is the government is looking to abolish multiple dwellings relief from 1st June 2024. If you've entered into a contract before 6th of March, that will be grandfathered and you will still be able to sort of access the relief. The better news is no change for mixed use acquisitions. That will carry on as we have been. I think the government decided to go the way they did because they were of the view that the relief didn't necessarily serve a purpose anymore. If we go back to when it was first introduced, it was aimed to support the larger institutional investors that were building up sort of sectors in the rental sector. If they were buying more than 6 or more units, their sort of stamp duty land tax rate would largely have been capped out at that sort of 5% commercial rate. So the potential win to them when the relief was introduced was the gap between 1% and 5%, so a 4% sort of margin. And given the introduction of surcharges in the interim, the benefit of that to organisations more times than not is down to 2%. And I think the government have taken the view is that just simply isn't worth the hassle of everything else that comes with multiple dwellings relief, in terms of sort of it's more the private individuals that are looking to push the boundaries on that. Now that will be a bit of a disappointment to some of those larger institutions, particularly given interest rates are high and particularly given the challenge in prices in that sector. But that's the way that the government's decided to run following that consultation. A couple of other sort of more niche points. The 15% rate is potentially going to be exempted for public bodies. There is a relief for the registered providers of social housing. And some of the references in that legislation was out of date, and they've been updated. And first-time buyers, there's an extension to make first-time buyers relief available if there's a nominee or a bare trust in the structure. And that's everything on stamp duty land tax. So without further ado, I will hand on to Caroline to talk about employment taxes. Thank you.
Thank you very much, Liam. I'm going to start by talking to the headlines that were over all of the websites, social media and newspapers yesterday evening and this morning. So next slide, please. That is no surprise, it's the 2% reduction in the main rates of national insurance. Now, that means that for an average worker on an average salary of £35,400 per annum, there will be a saving of £450, with a reduction in the main rate between the lower earnings limit between the primary threshold and the upper earnings limit going down from 12% to 10% during the current tax year. And then from April, it will go down by another 2% to 8% from the 6th of April. Class 4 self-employed people's national insurance main rate is going down by 2% as well. That means it takes it from 8% to 6%, and that is up to the upper profits limit of 50,270. I think really what's very important is what hasn't changed. And what hasn't changed is the rate of employers' national insurance, which remains at 13.8%, and all the thresholds, as well as the income tax personal allowance, which also has not changed. And therefore, this will go some way towards setting off that element of fiscal drag that we would otherwise see when the thresholds don't move. So moving on to the next slide, please. Something we were expecting to see featuring in the the spring statement. Gosh, it feels like autumn because it's freezing, but the spring statement is the results of the government's consultation on tracking non-compliance in the umbrella company market. Now, umbrella companies employ contractors who are generally engaged on short-term contracts, and you will often see that these are used by recruitment companies who are supplying short-term workers to endpoint engagers. And in the vast majority of cases, they are very useful for managing payroll. So they deduct PAYE, they deduct national insurance, and they will manage the compliance and administrative tasks associated with employing those individuals. But there has been some abuse. It's a key area of focus for the government. As I said, it was trailed that we would see the response to the consultation yesterday, but actually that's now going to be on what has been deemed Tax Administration and Maintenance Day. So mark that in your calendars. It is going to be the 18th of April this year. And we can look out for some more information on umbrella companies as well as other factors on that day. We can also expect some further guidance in the summer for workers and anybody else who might use umbrella companies. So watch this space. Next slide, please. Something else we were expecting to see some updates on following consultation is the support for occupational health provision. It was suggested that the government would be considering mandating occupational health provision. Could be through an automatic enrolment approach, similar to pension provision. But the budget was silent yesterday. We didn't see any new provisions. So for now, there are no change to the basic rules, and they will remain taxable as a benefit in kind. Next slide, please. One thing we did see that was a major change, and Ben will be highlighting this in a lot more detail in a moment, is the non-domicile rules reform and its replacement with the foreign income and gains regime, commonly now known as FIG. So I'm not going to spend any longer on that because we'll be hearing more about it from Ben in a moment. Something else that is taking place from the 6th of April is reform within the construction industry scheme. That will exempt certain payments from landlords to tenants from CIS under Regulation 24 extension, and gross payment status will not be refused anymore or removed if you have a minor VAT error. So that's welcome news taking place from the 6th of April, but that was already on the statute books. Next slide, please. Something else that we already know about, but I think is well worth reminding you about today, is the increases of 9% or more, so 9% up to 21.21% in the rates of national minimum wage, national living wage. So that is a significant increase, and it's going to really impact employers with a large number of younger, lower paid employees, apprentices, etc. HMRC have upped the number of individuals within their forces who are out looking at national minimum wage compliance. It will be enforced rigorously. There are no excuses, no get-outs. There's a series of targeting measures which are both geographical and sector. So, for example, if you're in retail or leisure and hospitality, you need to be looking very carefully at whether your national minimum wage rates are appropriate from April 2024. HMRC is directly mailing and advertising targeted at employees who are likely to be lower paid. If an employee whistleblows, then HMRC are obliged to look into it. And we've seen a number of war stories where there have been HMRC inquiries which are time-consuming and thorough. So it might be one person alleging that they're not paid national minimum wage, which can lead to an investigation of 2 years or more, looking at all salary records for all parts of a business. So it can represent a massive undertaking. So you really do need to be careful. And we're not talking about people trying to avoid national minimum wage in the vast majority of cases. What we're seeing are errors or mistakes. So it might be that you may have a policy that requires all of your outlets to record coffee breaks, but you might find that a small office or a small retail outlet is neglecting to do that. And that can represent a national minimum wage breach. Equally, you could be providing something that is intended to be beneficial. So, for example, inviting your employees in for breakfast before work due to high electricity costs, meaning it's cold at home. They don't want to spend money cooking a breakfast, so you can provide a cooked breakfast for employees. They come in an hour early, clock on, that counts as time available for work for NMW purposes and can lead you into hot water despite the best intentions. So do be very careful about how your policies are implemented in practice. Next slide, please. Now, something that didn't feature in the budget speech yesterday, but which actually represents a massive change for an awful lot of employers in the UK, is the mandatory payrolling of benefits, which is going to take place from 2026. Obviously, you can payroll benefits now, and roughly 5 or 10% of businesses already do that, but it is optional, and you have to obtain HMRC agreement in advance to do so. But from 2026, you're going to have to payroll benefits, so you'll have to establish the taxable benefit each payroll period. So that might be each month, it might be each week, or if you have less regular payroll periods, you will need to make sure that the correct amount is taxed at the pay date, and calculations will be required regularly to do that. This will be complicated. Don't underestimate the amount of administration that will be required, because if you have joiners and leavers, you'll have to recalculate. If your benefit cost changes during the year, and who renews their medical insurance on the 6th of April, so it will change during the year, you will have to recalculate. And all of that means that there will be less take-home pay at a time when inflation means prices are going up. So you need to communicate that to your employees. You need to make sure that they understand that because under the current system, they've been paying tax a year behind for employee benefits reported on their P11D. Once payrolled, they will be paying tax in real time. That means that for the period of change within your organisation, your employees will be paying tax twice on their benefits. You will be paying Class 1A national insurance twice in 1 year on those benefits. So you need to have a think about cash flow, budget for it as an employer, communicate the implications to your employees. Make sure your systems are ready. Make sure your payroll can do it. Make sure you have systems in place to calculate the benefits each month. Plan your employee benefits package. This is the time to go back and have a look at what the employees really value. Which benefits are attracting and keeping your employees, which are motivating them, and then therefore, which are worth maintaining. And test it out. Maybe payroll your benefits for a couple of your benefits in 25, 26, rather than leaving it to the last minute. That also can spread the pain of the effective double tax. Yes, it's just a timing difference, but they're going to have to pay it twice. And watch out during the course of this year for changes in the legislation. At the moment, you cannot payroll accommodation benefits or beneficial loans. If the government wants to payroll those, they will need to change the way that we calculate the taxable benefit. So look out for changes in the law on that. I think we have a polling question now. So Natty, if you could put that up for me. So the question is, and please choose one answer. Do you currently payroll benefits in kind? So your answer might be yes, or no, I'm planning to from April 2025, or I'm waiting until April 2026. No, but you do need to think about whether you're doing one of the two before. So I would go with one of the two before if you can. Or what is payrolling benefits? And if you'd like to have more information, please do let me know and I'll be very happy to help. So we'll just wait a moment to get the results of that poll in. Be very interested to see the results. Do we have those results yet, Natalie? Oh, apparently lots of people are still answering, so we'll just give it a couple more seconds. I think this is something that a lot of people are starting to think about now in terms of what's the impact going to be on your benefit package, your budgeting, your employees, and what are you going to do about putting systems in place to enable you to calculate the benefits that go through your payroll. Well, it looks like we might be getting the answers any second. Here we are. So we have 32% of people currently payrolling benefits, 9% planning to do so in the next 12 months, and then 14% waiting until April. Over a third just said no, and 6% would like some more information. So we will try and help you with that. Please do email in if you'd like some information sent to you. Thank you very much. I'm now going to hand over to Martyne Pearson, who's going to talk to you about indirect taxes.
I think I had myself on mute then. So I'm going to cover indirect taxes. Thank you, Caroline. So for indirect taxes, there's no big change to report, but there's some further consultations and changes are planned. Next slide, please. So the first update really is to the current VAT registration threshold. This is the first time in 7 years that we've seen an increase, and the threshold will go from 85,000 to 90,000, and the deregistration threshold will go from 83 to 88,000. It's quite interesting because we were potentially expecting maybe a decrease. There's a mixed review in respect of what people expect with regard to raising or decreasing the threshold and the impact that that might have on the wider VAT gap. So the government estimates that over 26,000 businesses will benefit from the increase in 2024 to 25 by no longer being VAT registered and paying the taxes over. And these changes will come into play from the 1st of April 2024. Next slide, please. So very interestingly, the VAT retail export scheme, we were expecting maybe some positive news coming out from the government with regard to the reintroduction of tax-free shopping. But as of yesterday, even though there's been quite a lot of lobbying in this area by the industry, the government has not gone as far as re-announcing the reintroduction of the tax-free shopping, which was originally removed after the 31st of December 2020. The government is reviewing existing position, and the report that has been issued by the Office for Budget Responsibility and is considering these findings further in the wider context. Quite, as I said earlier, quite disappointing for the retail sector, as there seemed to be quite a lot of expectation that this budget might bring about some changes in this area. I think we're going to have to continue to watch this space. And HMRC and the government are saying that they do welcome further submissions as to why it should be reintroduced. Next slide, please. So private hire vehicles, we talked about this in the autumn statement. So the government have announced that in April 2024, there will be a consultation into the impact of the High Court ruling in the Uber case. The Uber litigation requires taxi operators to act as a principal in supplying taxi services, which has the potential to impact the VAT position, because many operators who are currently applying the existing rules may act as under an agency arrangement rather than a principal arrangement on behalf of largely non-VAT registered drivers. So it has quite a significant impact moving from an agency to principal status. So it'll be interesting to see what comes out of the consultation. The government has said that they're very keen to explore a range of viable options that will work, that may work for the industry, because they don't want the court ruling to have undue adverse effects on private hire operators and all their passengers. So it'll be, as I said earlier, it'll be interesting to see what comes out of the consultation later this year. The next update really is around the alcohol duty stamp scheme. So quite narrow in respect of its application. So we are looking at the end of the operation of the scheme. It will be wound down throughout this year, and further guidance will be issued. The main aim really is to try to simplify the reporting for those affected, because at the moment it's overly complex with regard to the way in which the scheme is administered, and quite cost burdensome on businesses. Next slide, please. So now we look at the sin taxes. So there's a mixture of good and bad news in here. So no change to fuel duty. So it's going to remain frozen. Will remain. And for those that like a drink or two, the alcohol duty will be frozen until February 2025. So quite interesting support for the wider economy and those that are affected in that sector. We are seeing a potential new duty with regard to vaping products, which is probably no real surprise, considering other similar products often have duty associated with them. So we are looking at a consultation as to how that will be implemented. And it looks like we may have a new duty levy coming in with effect from the 1st of October 2026. At the same time, so from the 1st of October 2026, we're also going to see an increase with regard to tobacco duty. So the government are going to introduce a one-off tobacco duty increase of £2 per 100 cigarettes or 50 grams of tobacco. So again, trying to focus people's minds and spending around some of these sins. Also on the slide that seems to have disappeared from my view, we've also got a change of the air passenger duty rate. So the government's announced that it's going to make a one-off adjustment to the rates of air passenger duty on for the non-economy passengers. So we're looking at business class flights. And this is really to take into account of the high inflation in recent years and try to remain with a balance with regard to APD payable on economy versus business class. So the economy and domestic rates that are currently applicable for domestic and short haul flights will remain the same, and they will remain frozen until 2025. So that's good news for the average passenger. I can say the slides are back up, but they're at personal taxes. So can we have them back to indirect tax, please? If that's possible. Thank you very much. So that was the air passenger duty piece. So we've covered vaping, the fuel duty, the alcohol duty freeze, and the increase for the business flights. It's quite interesting. Maybe that's to help people make sensible decisions around carbon footprint as well. So it will be interesting to see whether there's any further changes along those lines. Before we move on to personal tax with Ben, I've also got three more measures just to highlight to you all. So just a reminder that we've got the carbon border adjustment mechanism, so CBAM, being introduced with effect from the 1st of January 2027. In yesterday's budget, it was announced there'll be further consultation later in 2024. So anybody affected should watch this space for more guidelines as to what that might mean with regard to the 2027 start date. Terminal markets order, so again quite niche and quite narrow, maybe for some of you on the call, but throughout the budget yesterday there was again a proposed reform. So the government are going to have a look at the TMO legislation, and they may be looking to bring in trades such as carbon credits into the scope of the terminal markets order. So again, if you're impacted or if you sit within that sector, it's worth keeping an eye out for the proposed reform details that will come out later this year. And then finally, if you're building your own home, so a slight change to the DIY builders scheme. So there was a change a little while ago, which meant that you didn't need to submit invoices when you were to file a claim to recover VAT on a new home being built under the DIY builders scheme. Very interestingly, from Rural Assent, HMRC are now saying that they're looking to pass some laws which allow HMRC to have maybe some extra powers to obtain documentary evidence to support these claims. So it's very interesting that when the earlier changes came in, they said, don't worry about supporting documents, don't worry about supporting invoices. But now they are putting in more measures to allow HMRC to look in more detail and request that documentary evidence in respect to claims that have been submitted. So almost a slight U-turn without having the individuals having to submit those paperwork like they used to. So just those three more to report. So as I say, not a huge change for VAT, but some interesting points for people in the relevant sectors to keep an eye out and to look forward to. So that concludes the indirect tax update. Let me pass you on to Ben, who is going to talk you through the personal tax changes that came out from yesterday's budget.
Thank you, Martyne. And I think for the audience, I think we've seen some hands go up, which we can't quite react to. So any questions, please do place them in the Q&A. So next slide, you can perhaps imagine where I'm going to head off when I'm going to start off my session. So certainly the changes to the taxation of non-domiciled individuals, something that has been kind of rumoured for a long time, and so it feels amazing that it's actually here. So what I want to do is just take you through in overview what those proposed changes are at a level, try and compare and contrast in terms of how different people might be impacted by those, and then also maybe some things which people who are affected may need to start thinking about, of which there's quite a few, and my list keeps growing. It's certainly a massive change and a massive topic. So what the government have said is they're looking to take away the concept of domicile from the UK tax system and place it more on a resident system. So the concept of domicile has been around for over 200 years. Those who have had to contend with it, advise on it, will appreciate all its nuances and so on. So maybe a move to a clearer residence-based system is welcomed. But for reasons we've come on to, the concept of domicile is still going to be important even post April 2025, I think. So from 6 April 2025, the remittance basis of taxation is going to be abolished, and there's a new FIG rule. So for those who don't know, the remittance basis is if you are UK resident here but not domiciled, so your permanent home is not here but you are a UK resident, your overseas income and gains is excluded from tax for 15 years unless you remit it to the UK. So it's going to be replaced by a new foreign income gain system, and this is going to be simply residency based. So if you've not been resident for the previous 10 tax years, you then have the next 4 years where all your offshore income and gains is not subject to UK tax, and you can remit that. There's no charge. You can opt in it year in, year out. The only thing is, if you do opt for that treatment, you'll lose your personal allowances or income and your capital gains exemption. There's going to be some transitional reliefs for those that are moving from a remittance basis to the FIG regime on 6th of April 2025. This new basis applies to income and gains only. There was also going to be some proposed changes to IHT, which we'll come on to, and that's going to be subject to consultation. So perhaps if we move on to the next slide, please. So transitional reliefs. So those who are moving from the remittance basis to the rising basis on 6 April 2025 and don't otherwise qualify for the FIG regime. So those who are currently non-dom and non-deemed dom, so those who are going to otherwise would have been had 15 years and now not going to because of the rules are going to be abolished from 6th of April. There's a transitional for 1 year period, so only 50%. You will be taxed on your income on a rising basis from 6th of April 2025, but only 50% of your foreign income arising in that year will be subject to UK tax. There's going to be no reduction to your chargeable gains. There's also going to be a temporary repatriation facility, and I think this was the headlines in the statement yesterday, where unlocking £15 billion worth of offshore income and gains is going to raise a billion or two of taxes as people bring it on shore. So a temporary repatriation facility. So this applies for the years ended 25, 26 and 26, 27 only. So those that have got pre-6 April 25 non-income and gains, which is offshore, which has not been taxed, there's going to be a 2-year window where you can bring that into the UK, and the rate of tax on that will be 12%. So those that have all done sort of in the past familiar with mixed funds analysis and cleansing and clean capital and offshore income and offshore gains, this sounds a bit of well, in headlines, a rather sort of welcomed amnesty to bring those income and gains into the UK at an attractive rate. There's also going to be a CGT rebasing election for personal assets held at 5th April 2019. So that's for personal assets only, not trust assets. And that only applies to those that are not currently DOM or deemed DOM. So those that are already deemed DOM would have had the benefit of the April 17 rebasing, if indeed they became deemed DOM as a result of those measures in April 17. Next slide, please. So inheritance tax, so to consult on the proposed changes. Again, going to move from a domicile-based system to a residence-based system. So for inheritance tax, currently all so UK domiciled individuals, so like myself, born and bred in the UK, subject to UK inheritance tax on all our assets all over the world, wherever they are situated, however they're held. If you are non-UK dom, non-deemed dom, you are only subject to UK IHT on UK assets and UK residential property held through foreign assets. And if you are non-UK domiciled, you're not subject to UK IHT on your overseas assets. And also there's a excluded property regime. So people who are non-dom and settled offshore assets into an offshore trust before becoming domiciled in the UK, those assets in the offshore trust are forever and a day excluded from the UK inheritance tax net. So the proposed position from 6 April 25, what's the same, what's changed? Well, IHT will remain chargeable on all UK situated assets. And what's the difference to overseas assets is IHT is going to be charged on personally worldwide assets once a person has been resident in the UK for 10 years. There's going to be a 10-year tail after leaving the UK, whether that's you just simply remain within the charge to IHT or some form of tapering. I guess we'll see on that basis. But also they've confirmed that the excluded property trust regime, that will remain. So assets that are excluded property within trusts at the moment, and I think those that are settled as excluded property before 6th of April 2025 will remain excluded. So they've put in a caveat subject to any future anti-avoidance provisions that they may look to introduce. Next slide, please. So there's going to be lots of different scenarios in the way people are impacted by these rules and these changes. I've endeavoured to sort of summarise maybe 3 key ones here, but there's probably various variations in between. So the concept of domicile has been around for a while, the taxation of UK res non-doms. So what we have is probably people who are UK resident but already deemed dom, having spent 15 out of the last 20 tax years, or at least 15 last 20 tax years here. We have those who are currently non-dom, non-deemed dom, and they may have become due to become deemed dom on or after 6 April 2025. That's actually going to be cut off sooner, as at 6 April 2025, the new regime. And then put simply, we might have our new arrivals who have been outside the UK arriving on 6 April 2025. And what does it mean for these people? Well, I think some of the key takeaways there, a busy slide, and hopefully all those boxes are largely correct. So tax on foreign income and gains at the moment. So those who are already deemed dom, already taxed on a rising basis. Those who are currently non-dom, they've still got the benefit of the remittance basis until April 2025, but it's going to be a rising basis thereafter. And again, this assumes it depends if you are been in the UK, been outside the UK for 10 years or more, because those new arrivals, so from 6th of April 2025, if you've not been resident, you have 4 tax years of where your offshore income and gains is exempt. Now, what they said is you can opt in year in, year out. Actually, if you arrived in say April 23, and you're having 10 years previously outside of the UK, you still got your residual amount of your 4 years post 6th of April 2025. We've got that 12% tax on remittances. So this is all kind of that locked up income and gains that are offshore. That 12% tax charge on remittances of that be 6 April 25 income. So that should apply to both our already deemed DOMs who have got offshore income and gains and those becoming deemed DOM on 6 April 25. 50% reduction on foreign income. So that's just those who are non-DOM, non-deemed DOM who would become who are impacted by the change on 6 April. That transition also your 50% reduction on your income for that 1 year only applies to that population of people. CGT rebasing at 6 April 2019, again, only those who are not currently domiciled or deemed DOM. can rebase assets at 6 April 29 if they so elect to do so. Some consternation, some pondering in the office why 6 April 29 has been chosen as opposed to April 25 or even today's date, but perhaps people brighter than me will elaborate. I was only sort of linking it to perhaps non-resident CGT and rebasing April 19, but maybe there's some other merits in there. And then also the sort of trust protection. So at the moment, income and gains of an offshore trust are not subject to tax on the set law if those trusts are protected. And people familiar with the concept will kind of know what that means in terms of maintaining domicile and sort of no further additions to the trust and so on. So what we'll have is from 6 of April 25, those income and gains will become taxable of the trust on a rising basis, whereas under the FIG regime, those new arrivals not being resident in the UK for 10 years will still have 4 years of that trust exemption. And we'll sort of come on to a couple of points on that front in terms of other steps. We then have IHT on personal property. So if you are deemed DOM, you are subject to inheritance tax on your worldwide estates. If you are currently UK res non-DOM, you're just subject to IHT on your UK assets until 6 of April 2025, at which point you'll be subject to IHT on your worldwide assets. And if you're a new arrival in the UK, for the first 10 years, just your UK assets. Once you've been here for 10 complete tax years, then your worldwide estate comes into the charge to IHT as well. And as mentioned previously, the concept of excluded property, no change for those people. I think yet to see a bit more detail for what it would mean for kind of new arrivals. But we think that, say, assets settled before 6 of April 2025 should remain as excluded property thereafter. So I think we're going to have a quick poll, if that's okay. So there seems to be a huge amount of kind of speculation and wondering about when non-dom rules will change and when they'll come about, if they'll come about. So just really interested from the audience today, just in terms of your initial reaction to the proposed non-dom tax reform measures announced yesterday. Do you think they've gone too far with the changes? It's a good balance, not done enough, you're undecided, or you don't really care, it doesn't really impact you? So if you wouldn't mind taking a quick couple of seconds to read through those and answer. Okay, thank you. Got some scores on the board. So yeah, so judging. So actually, half of you doesn't really impact you. Doesn't bother you. So yes, perhaps more in the margins in terms of too much, not enough, or a good balance, which seems to be leading out of those three as well. It's perhaps my personal view, probably as a tax advisor and as an individual, but we will see. So I think in terms of addressing those non-dom changes, I think there's a lot of perhaps I appreciate it's perhaps not of relevance to 50% of the audience, but just thinking about those next things to do next. Obviously, those impacted have got to take advice from the advisors. You know, we're yet to see detailed legislation, but there's going to be a lot of things to work through. The transitional relief for bringing off offshore funds, there's probably some calculations to be done there in terms of how worthwhile it is. 2019 revaluations, if that's impacted you, maybe getting those done, because 2019 is only going to get further away, not closer. All these with reference to residence is still based on the statutory residency test, so that won't change. And so people who are internationally mobile or spend their time between different countries may be considering leaving the UK or reliance on the statutory residency test. Trust income and gains, it will become taxable in certain circumstances, as we said there. it's quite often that overseas trusts will have offshore companies. So there's probably going to be more need to look at other anti-avoidance provisions which can actually attribute that income of offshore companies up the chain. We see a lot of inquiries on non-domiciled individuals and their status. I expect that to continue, you know, particularly whilst there's an amnesty for non-doms bringing unremitted income and gains into the UK for those 2 years, for example. It's still reliant on the fact that that you were non-dom at the time those income and gains were actually realised. Settlement into trust, so that excluded property regime seems set to continue. So there still seems a window of opportunity for those who are not dom to settle trust pre-6 April 2025. People who have maybe been out of the UK for 5 or 6 years or have been visiting, they will be to currently avail of the 15 out of 20 year rules, might be considering staying out for 10 years and coming back with the FIG rules in place. Yes, and I think non-dom status said is still very relevant. So, you know, to sort of digest a lot in less than 24 hours, it's a subject that will probably take, you know, 2 hours in itself in a webinar. So hopefully it's giving you an overview there. We'll come on briefly a couple more changes. Appreciate time is going over our time slot. Next slide, please. So just a heads up on some property tax changes. So you would have seen gains on residential property reduced from 28% to 24% from 6 April 24. Sorry, it should be from 6 of April 2024. So that's a part of a motivation for those with sort of buy-to-lets and landlords to be encouraged to dispose of properties. The basic rate still remains 18%, so there's no reduction in that from 18 to 14. That remains at 18, and carried interest remains at 18 and 28%, so no changes for those. Liam has talked about the SDLT multi-dwellings relief. We did wonder whether there's a very brief window there between 6th of April and the 1st of June where both purchaser and seller are able to benefit, with the purchaser benefiting from multiple dwellings relief and the seller benefiting from the reduction in CGT to 24%. And furnished holiday letting. So this is a regime where furnished holiday falls within certain requirements and parameters and run as a business. It is treated as a trade rather than a property investment. So this means full relief for interest costs. This means business asset disposal relief and 10% tax when you sell. It means capital allowances, and it can mean holdover relief when you sell assets and reinvest them. So within certain criteria, treated as a trade rather than investment. That is simply going to be abolished from 6th of April 2025, and people who run furnished holiday lets will be treated as a property investor and subject to those rules. And then I think my final slide, just to cover the high income child benefit charge. I'm sure you would have seen this in the newspapers overnight and the news and so on. I think a sort of welcome change here. So those that get the income child benefit, previously it was restricted once someone in the house earned more than £50,000. That's going up to £60,000, and the tapering. So when that start to claw back, the tapering has gone from that first £10,000 to actually £20,000. There's still some talk of whether they're going to look at household income, because it still might be the case where perhaps, you know, two people on £50,000 can be better off than someone where one person is on £80,000 and the other person are not. It doesn't have an income. So we'll wait to see those changes, but I think these must be a welcome change in the meantime. So appreciate we've probably gone 10 minutes over our allotted time. Perhaps we'll go to Q&A. I think we'll take a look, and depending on who's best placed to answer those questions might depend on who's best placed to ask them.
Yeah. Ben, I think when you've been, as you've been speaking, I think there's a whole raft of questions in there for you on the non-dom. So if I give you a second to sort of digest those, and I might ask you a few, but before we get stuck into those, there is one, Caroline, on IR35 and umbrella companies and sort of the impact that umbrella company changes have on IR35. Do you want to come in on that one?
I mean, at the moment, we will have to wait until the 18th of April to see what changes, if any, are going to be announced. So there was nothing announced yesterday. So today, nothing has changed. It's a case of watch this space. There is a requirement on all engagers of off-payroll labour to do a thorough labour supply due diligence exercise to make sure that if workers are providing services through a personal services company, then their employment status for tax is assessed very carefully. And if they are a deemed employee, then the person paying their fees needs to be deducting PAYE and national insurance on their deemed income. Most umbrella companies will not be treated as a personal services company. So whilst you need to still look out for a PSC in that labour supply chain, if an umbrella company exists, it will be operating PAYE and national insurance anyway on the supply of workers' services. So, as I said, nothing at the moment has changed.
Ben, there's probably a quick question for you around business investment relief and whether that's going to be abolished too.
No, that's set to remain. So those relying on business investment relief, that will remain.
And then I'm just conscious of time. There are probably a series of questions, Ben, that are around non-dom and how that works in detail, around how it interacts with UK individuals coming in and out of the UK. What I suggest we do is if we pick those up sort of after the event and get back to people in individually, because we're kind of running out of time.
I think so. I was going through, I do have some answers, but there's a huge amount of detail there and kind of what ifs, so it makes sense, and we'll come back to those afterwards if that's okay.
Okay. Should we wrap up the Q&A? Ben, are you going to wrap up the presentation?
Yes, I will. So thank you, everybody. As I say, we're sort of welcome. We will send around the slides. We will send around the recording. I think we had one last poll. If you'll kindly bear with us for one more minute and take a few seconds out to answer that for us. Is the poll up on screen? I haven't got listening for my floor manager to come up. Yes, it's up. So I think it just leaves me to thank Nina very much for joining us today, to thank the panelists for their time, watching the budget with close watch and the materials and preparing the materials and joining us today. Thank you all for joining us as well. We hope that that's been of some use. Very welcome to pick up questions afterwards. So I think without further ado, I will say thank you, wish you a very good rest of the day, and speak soon. Bye, everybody.